Okay, Anna, if you can put my slide up just briefly. Okay, good morning, everybody, and welcome to our webinar, Getting Out of Debt, which is part of the Keep Britain Solvent series and run in kind association with Aryza. We've got three aims out of the discussion today. We want to canvass a range of opinions from different relevant sectors of the credit industry. We want to, hopefully, really, to come up with some very strong conclusions that we can give to government, to the powers that be, to regulators, about how the industry can sort of move forward and tackle the current debt situation. And we want to sort of feed these conclusions as well into our ongoing campaign post lockdown and all the rest of it, as part of our Keep Britain Solvent campaign, which is a campaign that is running to keep both the commercial sector, business sector, and consumer sector, Joe Public, solvent moving forward. We've got a great panel of panelists lined up today, and I'm going to get them all to briefly introduce themselves, starting off with Jonathan from Christians Against Poverty, who can then sort of hand on the baton through to the rest of the panel. So Jonathan, please.
Yeah, thanks, Gerard. Yeah, my name's Jonathan Shaw. I'm the Creditor Relationship Manager at Christians Against Poverty's External Affairs team. So I manage our relationships mostly with enforcement agencies, but also in the world of consumer credit, I'll be our CAPS relationship manager for all the high street banks, debt purchasers, debt collectors, providers of personal credit, personal loans. And started my time at CAP, a few years of debt advice, which is a really great foundation for this role now.
Thank you. Lukasz, please.
Hi everyone, great to be here. I'm Lukasz Krebel. I'm economist at the New Economics Foundation, which is a London-based think tank focusing on making the economy work for people and the planet. And in my role, I'm focusing a lot on the financial system, how to reshape finance to serve environmental goals as well as social objectives. And I've done also a bit of work on social security and dealing with inequality in the UK economy.
How long have you been there for, Lukasz?
I've been at NEF just over 3 years now.
Okay, so good position to know. Joe, please.
Yeah, good afternoon, everybody. So I'm Joseph Bowie. I'm Chief Operating Officer and Head of Lender Services for Moray Group. We're a professional services business. We are heavily involved in the lender services side of the industry. So we are debt and asset recovery, I suppose, litigation lawyers, and deal with obviously customers that are in arrears, looking to either break that cycle or are specifically going through the repossession route of obviously their assets being recovered. I've been involved in this industry for about 12 years now, and have been offering pan UK legal solutions as well. So not Scottish specific, but we'll be doing England and Northern Ireland as well.
Wales?
Yeah, and Wales, yes.
Wales, good at rugby. Right, thanks for that, Joseph. And then finally to our great sponsor, Martin.
Yeah, hi, afternoon, everybody. So Martin Prigent from Aryza. I'm a director that works in sort of partnerships and part of business as well. For those of you that don't know, Aryza is a business that provides software solutions and also services as well to lenders, and we provide platforms for each step within a sort of lending and debt life cycle as well. So we provide loan origination software, collection software, management software, and probably quite pertinent to this conversation, insolvency, case management systems, and bits and pieces and tools as well there.
That's great. Thank you, gentlemen all. If you have any questions, attendees, feel free to chip in on the chat box, which pops up on the right-hand side. We have had quite a lot of pre-questions, which we try to sort of fit into the broad topics that we're going to be discussing today. The first question I'll send over to Jonathan at Christians Against Poverty. Then I'm going to ask the same question to Lukasz, who is just because he's made some nice slides before this event. We're going to give him the screen for a couple of minutes, and he's going to whiz through these questions. But the first question is going to go to Jonathan. Jonathan, how big a mess do you think we're currently in when it comes to debt in this country?
Well, I should caveat my response in terms of Christians Against Poverty service. We provide a free face-to-face debt counselling service that meets our clients in their homes directly. So it's a service is very much geared up for helping people for whom online or telephone advice would just not cut it. They need that intensive emotional and practical support of somebody actually coming to see them. So we see a very vulnerable kind of client demographic. It's a service that could help anybody and everybody, but it particularly thrives in helping people that for whom they haven't been able to get help elsewhere. So from our perspective, from what we're seeing is it's really a case of priority debt becoming a growing issue. And just to explain what priority debt is for those who might not know it, so anything that may be secured, like a mortgage or rent, or anything that would have quite dire consequences for lack of payment. So energy, an enforcement agent coming round, all of those sorts of things, a court fine, anything like council tax, things like that. So for our clients, in our latest report, we found that of the total debt makeup that our clients have, 39% of that is priority. That's individuals, it's families, it's people that are struggling to keep on top of the essentials. So we really want to dispel that myth that perhaps the debt situation that people find themselves in is because they're living some sort of unsustainable lifestyle that is beyond their means. It's not ridiculous hire purchase agreements. It's not getting the latest car. It's people that will turn to credit as a means of keeping on top of the essentials.
That's great. So Lucas, over to you, and slides for a minute or two, please. Anna, can we just swap that up now? And just taking those points that Jonathan's made about priority debt, this will be impacted by some of the macroeconomic factors that you're going to very briefly talk about, right?
Yeah, thanks, Anna. Yeah, if we can make it slightly bigger. So on the first slide, it shows the Bank of England data on the evolution in consumer credit. So that actually excludes mortgages. It focuses on credit card debt and other types of loans and advances, as mortgages are quite of a separate type of debt. So I picked this series here. So what it shows, we had a decrease in this type of borrowing during the pandemic, probably as people were locked down and just spending less or receiving more generous universal credit support or furlough payments. But we see this has started to increase over the recent months. So if you look towards the right end of the slide, especially from the beginning of January 2022, the levels of new debt, so the debt on top of repayments, has been now running for 3 months above the levels pre-pandemic. And in particular, the increase in credit card debt has been quite substantial, with about 0.7 billion over each of last 2 months. So signifying that, yeah, people are forced to take this very expensive credit card debt to pay for the essentials. Sorry, can we go one slide back? Yeah, the second one, yeah, one after. Thank you. And yes, so here in terms of the total amounts of debt, they are quite substantial. So consumer credit card debt has reached almost 61 billion, or if you try to divide it on average by every adult, it would be over £1,000 per adult person in the UK. The total for other loans and advances, excluding mortgages, is 141 billion. But obviously the biggest part by far is the mortgage debt. So this part of priority debt that I understood Jonathan was talking about is over 1.8, well, almost 1.8 trillion. And as we can see, that the rates of those various debts has been, again, climbing quite rapidly after the COVID dropped down. So it again signifies that there are economic pressures. And can we go to the next slide, please? Be wrapping up quickly. Oh, yeah, sorry, Anna, would you be able to go, I think it was slide 9 on the, if you go a few more further down. Yeah, just the previous one. Thanks. Yeah. So here, I think that this one maybe tries to summarize a lot of the issues happening in the economy. So I'll just explain that and wrap up on this slide here. So what we are seeing, obviously, is the massive increase in inflation, driven in large part by energy prices, by the cost of fossil gas, as well as supply chain issues. So there was a big increase in prices now, being seen across the board. Bank of England forecast the inflation will now increase, exceed over 11% by end of this year, which is like the number not seen for decades. So that has obviously putting massive pressure on people's budgets. So what this chart here shows, I can see those bars reaching out towards the bottom. They show the reduction in people's spending power due to inflation because of increase of the cost of essentials. And they are based on a basket of goods developed by University of Loughborough, which is called MIS, Minimum Income Standard. So trying to capture what are the actual essentials that people need to live decent life. And the bars are much bigger on the left side. So they are the people in the bottom deciles of household income. So as a proportion of their income, that the increase in costs impacts them much more strongly. And we also illustrated, like, the government announced a number of measures, packages of support with energy bills, with some temporary direct payments, but nonetheless, you might have seen there were like those black dots showing what is like the net result by October 2022, and it shows that people in the bottom half, and especially the bottom quarter of society, are still very negatively impacted. So
thanks a lot, Lucas. That was great. Thank you, Joe. Are you starting to see some pressure now within the legal system? What are the warning signs from your perspective as a solicitor that we might see in the legal system now?
Yes, I think one of the key measures is actually what the lenders are forecasting volumes to be in the recoveries litigation space in the coming probably 6-12 months. I think what we're seeing now is a number of lenders now reaching out to expand their panels. So the number of firms that they have on their panel that they can instruct to do litigation and debt recovery services for them. So the creation of contingency panels there. So should we see an increase in volumes or an increase in volumes that they are expecting or can't support through their existing panels, they'll use a contingency panel for. So we're in discussions with a number of UK lenders and creditors now about what that looks like, and I think that's an early sign for us. I think the real difficulty we have is probably the distinction between pre-COVID debt and post-COVID debt, because of the amount of forbearance now that's been offered by lenders during that period. I think there's a real blend in there, and I think it's difficult for some to be able to identify really actually what or how severe the situation is.
That's great, thank you. Martin, from your point of view, your systems, are you starting also to pick up bits and pieces of statistical, quantitative evidence to see how things are moving?
Yeah, we are. I mean, I'm going to be cheeky and kind of give two viewpoints, I think. So from our insolvency side, we are starting to see increases in personal insolvencies sort of coming through the system now. And actually at the front end, those personal insolvencies are coming through, and their contribution levels are starting to reduce a little bit. So you can see that compression on affordability starting to come through at the back end. Interestingly, if I'm talking to the sort of the grassroots level with providers in that marketplace, actually for consumers that are actually within solutions at the moment, that cost of living squeeze isn't really impacting so much at the moment, but they are expecting over the next sort of 3 or 4 months for that to start to kind of flow through a little bit more within their supervision, their sort of supervision of cases. Interestingly, from our perspective as well, it's not necessarily the volume, because I think that reflects in the market anyway, but we are seeing consumers getting younger, and that mix of kind of consumer age is starting to move within solutions. That's an interesting dynamic. And also that is kind of driving or being exposed to then a different mix of debts going into solutions as well. So we're starting to see a rise in credit card debt, retail credit, those kind of debts now starting to come to the fore in terms of volumes coming through. And just very quickly as well, Gerard, sorry, on the outreach solutions that we have, so sort of digital customer outreach that we have, we are starting to see, certainly with creditors and debt advisors, much more interested now in those types of products that can sort of try and get and contact customers at scale and try and provide solutions to them to either self-serve or to sort of help them along the journey. So digitization from our point of view actually is increasing quite quickly at the moment.
Okay, that's great. Let me put that point back to Jonathan in a second. What I want to try to do here is lump together two sort of big topics for the next 10 minutes, which are forbearance and vulnerability. Talking of forbearance, the question to the panel is, what does the panel think are acceptable, if any, levels of forbearance, and how can this be enacted in the legal system? Jonathan Shaw from Christians Against Poverty says, there's no one-size-fits-all solution to forbearance, but it is encouraging to see so many firms adopting different forbearance strategies that are based on the customer or client's unique personal circumstances. What's essential is that customers get the right support needed to better their situation, and if that's debt advice that's needed, the relevant information needs to be presented so that they can make a well-informed decision. And now, back to the video.
Yes, the court process is set up for the customer. I think it's whether or not they engage in that process, whether or not they have sufficient representation in that process as well. Again, a lot of people, very generalized statement here, but we see a number of people burying their heads in the sand at that point, and that's probably the wrong thing to be doing.
Okay, great, thanks for that. Let's try and move on then briefly to this topic of vulnerability that have been raised by so many of the attendees who are coming in. And I think the question here that I've got anyway is what progress can we make in trying to define what vulnerability is? I mean, we hear a lot of conversation about it, but what does it actually mean in practice? And are there ways in which we can try to quantify that? Martin, did you want to have a go at that first, please? Are your systems in any way equipped to deal with that?
To a point, there's a lot of interpretation, I think, there, Gerard, in terms of how do you assess and provide the channels that are available. I actually think from a regulatory point of view, I think the FCA and the way that they're thinking about it and the questions that they're asking the marketplace at the moment actually are quite interesting and quite a good attempt to sort of try and pull that together, sort of look at it in 4 different categories. But if you sort of look at the types of vulnerability that are being called out there, so you've got health.
What are those categories? Sorry.
Yeah, I'm going to read these off, Gerard. So apologies when my eyes shift slightly to the right hand side. No. So the categories for the FCA, we've got health, we have life events, we've got just underlying resilience and capability. So that badges quite nicely in many ways. Now, from our systems point of view, we're pulling in, there's different ways we can do this. We're pulling in data from a lot of different data sources, including things like the vulnerability register as well, which is a very helpful resource. So there is sort of very obvious vulnerabilities within some of that information that we can pull together. You can then identify vulnerabilities from other data sources like open banking, for example, credit bureaus, that type of thing. You can provide questionnaires, so the customer themselves can actually provide insights into their current position, and you can provide some logic around how you think about that. It's always sort of trying to understand this sort of perception of vulnerability versus actual vulnerability as well. And I think you always need to sound this with the client. But from a creditor's point of view, from a collections point of view, if you see something that could be of interest, bear in mind we're seeing vulnerability is such a large part of the sort of UK debt landscape at the moment. You can start to put different channels from a creditor and a collections point of view in place to deal with those customers in a different way. So you can triage better by having these different data sources and by having some intelligence. It's not a simple solution. There's just not, I don't think there's one way to do this, but I think that actually you're pulling in so much information, you're asking questions directly, and you can start to make some assumptions yourself about treatment as well, that you can start to create that.
That's great. Coming over to Jonathan. Jonathan, are we in a genuine strange period still at the moment where our definition of what vulnerable is basically we've ripped it up and we're starting again. Would you agree with that?
I think it's as Martin said, I think the FCA definition of it is a really robust one. Perhaps the CEO at Three Hands is vulnerability is essentially stuff that happens in life, and we're all susceptible to it, and we're all on a varying scale of it. And so it's almost like this. It's been theoretical, well, it's turned into a theory, hasn't it, really, in terms of the different circumstances that people can find themselves in and how firms should respond in response to that information being shared. I think for us, we're very fortunate as a debt advice provider that meets clients face to face, and you go into the home and you see firsthand precisely the full circumstances that person's in. It's how that information is shared and how all the different players in that one person's life come together in finding a solution for that person. So it's how we share that information between us and that client, and then how we share that with their local authority, or how their creditors are informed of that, and how full of a picture you can paint of that person's unique circumstances. And then the real challenge is, how do you do that to scale in such a way that actually vulnerability doesn't just become this buzz phrase that then is watered down, and the people that try and cheat the system say I'm vulnerable because I've stubbed my toe, versus the person that kind of goes in on themselves because life is so tough, who is genuinely vulnerable, isolated from friends and family, in thousands of pounds worth of debt, and just in no position to get themselves out of that situation alone. So that's the challenge that we have, I think.
Thank you. Lukasz, but let's sort of link vulnerability also to affordability in the first place. Do you think that we can do that better than what we have done before? So we start to look at what credit people are being given in the first place, where we take on board, what is appropriate credit, what is affordable credit. So we try to sort of minimize the debt and the debt problems at the back end of the system.
Yeah, so I think linking this to affordability, I'll take maybe a bit more systemic view, because what makes people vulnerable and unable to afford the debts, it often results especially for people low incomes, and how our social security system is set up. So like issues with universal credit, where people do rely on getting their payment on time and getting the correct payment, and but it doesn't happen, they miss their repayment deadline, they immediately get hit with like some fine, late repayment fee and so on. They need to maybe go to a payday lender, and that massively increases their exposure to debt, and that debt that might have been affordable to begin with, because of some administrative issue with the support they were receiving, suddenly becomes unaffordable, and they go into this spiral. And it does seem to be like a persistent issue that the system treats people with all the doubt they can have, and all the issue is always landing on the recipient side, not on the state side. So I think that's one way of responding to that, because otherwise assessing affordability relies on having some predictability of the income that the person will receive. If you don't have it and it's generated by the state itself, that's a big issue. And similarly, the thing about the gig work, casual work, like 0 hours contracts. Again, people, may expect they will be getting their hours. They'll expect they will get a certain level of income. So they maybe say, okay, this is affordable for you. But then, they don't get their hours for whatever reason, or they fall ill, they don't have insurance, they miss those hours, then they cannot afford to repay. So thinking on the systemic level, what the government can do to set the floor at the higher level to protect people from falling through those cracks.
That's great. Let me just now address two specific areas. First of all, local authorities. We've had a few local councils that have registered for today's event. Has the panel got any specific advice now for local councils sort of moving forward from a collections and a legal point of view over the next sort of 3 to 6 months? Who wants to pick that one up first? Maybe Joe, could you have got that one, please?
Yeah, by all means. So I think everybody's agreed that vulnerability is a difficult subject to navigate yourself through. Identification is key, I think, in this. I think in the legal sense, you need to establish pretty quickly what the impact that vulnerability has on the ability for the individual to make payment. And that is something that we try to identify early on. You know, if it's a self-employed builder who's broken their leg, clearly there's a physical vulnerability there that is going to stop them incurring an income. There are other vulnerabilities, though, that people live with on a day-to-day basis that, whilst they can be absolutely vulnerable and identified as vulnerable, it doesn't impact their ability to make payment to the creditors. And there needs to be that differentiation made. And again, as an industry, I think historically we've been very quick to identify people as vulnerable and having that black and white marker on as being vulnerable or not. And I think it needs to be more transitional about what the vulnerability is. And again, as I say, what impact that has on the personal circumstances, but more on what that has on the impact to make payment.
Jonathan?
It's a really tricky one, because I do feel for local authorities in terms of the financial pressures that they're under and the task that they have to be able to collect as much council tax as possible for the provision of some essential local services. You know, it's difficult because the issues that we see is where you have people that really shouldn't, who do fall into difficulty, end up perhaps falling behind. A liability order is issued and then it ends up, say, with enforcement agents where it shouldn't have done. And then, so how can the use of data kind of stop those people that really shouldn't get through to enforcement sooner? But I appreciate the capacity of local authorities to actually be able to look at all the different options available and see what suits them best. It is really difficult. What I'd love to see, though, is a greater coordinated
outreach. Jonathan, sorry, just repeat the line about data, because I got a crackle in my ear.
There's loads of different kind of data firms out there that can help local authorities pick out people according to income type, according to whatever, that would perhaps be more susceptible, you know, be particularly more vulnerable, and therefore actually if you're not getting your full council tax support award because of the area that you live in, you're on universal credit. What else can we, how else can we use tech to actually pick out the people that actually they're not deliberately avoiding paying? There are other factors at play. So there's that. On a national and on a local level, I would love to see a more coordinated attempt by, or a consistent attempt by local authorities to reach out to debt advice. That on a local level, we are a community-based debt advice provider, and so we have different levels of engagement with authorities across the board because of either our presence there or their resource to be able to do it. So I'd love to see a greater level of collaboration there. I appreciate every local authority will have different advice providers available to them.
That's great. It's Russell from Civia there. Did you want the microphone for 20 seconds, Russell?
Nothing like being dropped in at the deep end, is there?
Sorry, but you were expecting it. Please, just.
I suppose what all I would say is that, you know, the system that we've created enables the debt collection part to be done at no cost to councils by the private sector through enforcement firms, and that so a lot of the kind of the data analytics, and the sort of data science that's applied to try to filter people from, you know, sort of vulnerable can't payers to people who are sort of deviant payers or non-payers of their taxes and fines, falls to those firms rather than to local authorities. Therefore, it's in local authorities' interest to pass it down, if you like, to those firms, pass all of the cases to those firms, and then get the firms to do the filtering for them. And the downside of that is that you are then in the enforcement process. You've been through the courts and you're in the enforcement process, so there's a degree of stress associated with that. You know, increasingly the role of enforcement agent is to identify vulnerable people and find out how they can help them, because there's more higher incidence of knocking on doors and identifying vulnerability. As Jonathan said, very often the only way to properly assess someone is visiting their home. Then there is incidents of people who are not paying. So you know, we've created a system whereby we are now pushing people further down the system to the point at which they can be filtered for free to the local authorities.
Okay, thank you. Martin, have you got any thought analysis on this local authority angle?
Well, I just wanted to raise a couple of things there. The Crown Commercial Services ran procurement processes and to sort of upgrade their procurement frameworks towards the end of last year. So actually, sort of digitisation and solutions for open banking and affordability assessments and those kind of software providers and service providers are now actually on the CCS frameworks for debt resolution services. So that, I think that's a good step forward. Aryza's on there as well, which is also why I'm sort of stating that. But I think just going to this sort of vulnerability piece as well, and I think vulnerability obviously is prevalent, and we're seeing that, but we are also seeing a different demographic of consumer in collections environments as well. And there's a lot of self-serve available, I think, as well with some of these consumers. And actually, for a sort of standard collections environment at the moment, we see an engagement rate for somebody going through an open banking and affordability assessment journey, one of these digital journeys. The take-up rate for that is somewhere up to, the band is somewhere between 28 to 42% take-up rate. So I think if the incentive is right, and you can incentivize consumers to go through these journeys, I do think that there is there's an appetite for consumers to go through these journeys and complete something either at their own time or at a sort of in a way that works well for them.
Okay, that's great. That sort of concludes this section, I guess, with vulnerability and affordability, linking that up to councils. Has anybody got a burning point that they haven't said yet that they want to get out there before we talk about something else, which is insolvency? No? Okay, right. So look, I'm going to go back to Lukasz now. I can't quite recall, Lukasz, from your slides, to what extent you are predicting, if at all, insolvencies sort of moving forward over the next 6 months to a year. Have you got a thought on what we might be likely to see, the best possible tools that we can use to manage insolvency? Although I'll throw that over to other people as well. And how much insolvency can we cope with it as a country?
Okay, that's a few heavy questions on that one. So, I mean, the economic trends we were seeing, unfortunately, point in the direction that we will be seeing more insolvencies, as already one of the analysts mentioned that we've started to see them already in Q1 this year. And with inflation increasing still, I don't know, meaning to exceed 11% in autumn and the new increase in the energy price cap, I would expect, the cost of living will put even more people into the very difficult situations that they just have no other choice than take additional credit that they may not be able to afford in the long term, or push people who are already in high levels of debt exactly into insolvency. And there will be the link also to the Bank of England's response to inflation, which is interest rates. And the bank started to increase interest rates, which will have impact on the cost of mortgages as well as other types of credit. And so people who were, again, just on the edge of this affordability under these extremely low interest rates we had over the past decade, especially during the COVID pandemic, they will be exposed by that on one hand, by increasing costs of their daily essentials on the other hand, and also with the economic climate moving towards higher unemployment as the Bank of England forecasts. If people lose their jobs, they'll obviously be more exposed to not being able to service their debts.
Sure. So how bad is it going to get? And that's sort of the question that I asked at the start, but how bad and what can we cope with as a nation?
So I think we had the number of insolvencies was about 35,000, 40,000 in the first quarter of this year, if I remember correctly. So I would expect it could get significantly worse without additional measures of support. I mean, how much we can withstand as a nation? I mean, the current numbers are already bad enough, in my view. We should not really make allowance for letting this get any worse. I think we've seen the government, when they are put under significant pressure, they do come up with measures of support, as they done quite recently. And those measures typically look to be falling just short of delivering help to everybody, but they are mitigating this impact to some extent. So, I mean, there is the hope of the situation as it is. The political considerations will drive the government to come up at the last moment with some measures of support. So I think, unfortunately, we'll need to see a further increase in insolvencies and people getting into bad debts and so on. But at that point, the government, I would hope, will intervene.
Thank you. Joe, is the court system equipped to cope with this? I think sometimes the court system needs a bit of a pat on the back, doesn't it? I think it does do a good job in certain respects. How can it cope with a potential further increase in insolvencies?
Yeah, I mean, I think it does deserve a pat on the back. However, we've seen court closures, and we're going to see demands on the court that they haven't felt for the past couple of years. In that, we've seen civil servants moving on in roles. So I think there's going to be increased pressure on the court service, no doubt about that. I think in the legal space, it's important for IPs, insolvency practitioners, and the litigation lawyers to have open and honest dialogues on a regular basis to work out what the best recovery method is for the individual, but also for the creditors. To save duplication of costs, to fast track cases where they need to be. So again, sometimes the right outcome for the individual is to progress that as quickly as possible with as little hurdles in its way. So, again, it comes down to hopefully the IP and the individual firm working closely together, providing the correct advice, working in the best interests of all parties. We are then subject to, sorry.
So what do you think would be the IP, the insolvency mechanisms, the best ones, most appropriate ones moving forward for individuals?
Not my specialist area, and I would
Okay.
hate. So it's probably a lawyer's answer, but I'd hate to go move into a space where we're offering advice for others. I think it's about looking at the best opportunity for the circumstances of the individual. I think, and that's a very vague and broad answer, but I think that there isn't a specific solution. I don't think for everybody. We've got to tailor it to the individual.
Jonathan, briefly, and then Martin, please, on that point.
Yeah, so with insolvency, we used to do 60% of our caseload was debt management plans, and insolvency was a third. We now see about 63% of our clients going through insolvency, and that's steadily risen over 10 years. And 60% of that 60 is debt relief orders, which was for relatively low amounts of debt and low incomes, and it was almost like a bankruptcy light. Now, the Insolvency Service changed the entry criteria for debt relief orders because essentially it was forcing too many people that were on a really low income with a relatively low level of debt into a bankruptcy, which costs almost £700. So they have amended that to make sure that people are getting into the right solutions. But that is almost the rise in insolvency for us is a secondary issue of the fact that incomes aren't enough to match expenditures. So we have about 50% of our clients with a broken deficit budget when they come to us for help. That means that we can get you through a debt relief order in a matter of weeks. We can clear upwards of £30,000 worth of debt, and we can get you into that process quite quickly. The issue is, once you're out of that, if you haven't increased your income, you are going to be in a similar situation 6 months down the line, and that solution is no longer going to be available for you. You may have to go bankrupt for an even smaller amount of debt. So the issue is more about incomes aren't matching just the cost of living. And that's the bigger, I think, from our perspective, we as debt advice agency cannot indefinitely, at the cost to us, put people through insolvencies without there being some material income, change in income for people.
Thank you. Martin, please.
Yeah, and I think the challenge there when we sort of talk about which is insolvency the right solution is actually there's a range of insolvency solutions, and it's a pithy answer, but the actual actually is it's whichever insolvency solution is right for that consumer, and bearing in mind things are circumstances are pretty volatile at the moment. It's very difficult, I think, in 6 months' time to go, okay, well, we'll see a prevalence of this solution. Consumer insolvencies are 17% higher now than what they were this time last year. So there's definitely, access to those solutions, and people are being supported to those solutions. I think where insolvencies are there for entrenched debt, that's where you need support, you need help, you are entrenched, and you need to rehabilitate over time, I think. However, I think in all of that, I think the earlier intervention by creditors is important as well. So the earlier you can talk to consumers, the earlier you can work with them from a consumer-centric position and understand their full landscape of challenges that they have personally. I think then that starts to reduce the impact on them and the economy further down the line. So I think the early intervention is becoming more and more important here.
Let me just flip that question around very briefly the other way. Are the tools that we need there in the system currently?
I believe they are. I believe they're maturing, actually. I think there's a lot of tools there now.
Just give us one or two examples, just for the record.
Okay, so obviously it'll be an example from Aryza. So we have a solution called Aryza Recover, and Aryza Recover is basically it's a solution that can sit by itself as a collection system, or it can sort of sit around a collection system. But it's very much around a digitized journey for a consumer. So a consumer kind of goes through this journey. An affordability assessment is created either through open banking or manually with that consumer. It can pull in credit bureau referencing into that. It can look at benefit entitlement. It can look at vulnerability registration service, pulling a lot of other sort of data sources as well, and then come out with plans for the consumer that the creditors can then sort of take as payment plans, or the consumer can then be directed for additional debt advice if they need it. So those types of solutions are there, and there's a range of solutions for that, not just Aryza.
But I guess I was trying to link that to a specific insolvency mechanism.
Mm-hmm. Well, so what can come off the back of that? Obviously, what you're doing there is you're doing an affordability assessment, but also determining whether this is a sort of current issue and potentially could be a short-term issue, or something that could be a bit longer term, a bit more entrenched. Now, out of the back of that, you're going to have an idea for what that is. There's then a consumer choice where the consumer can be presented with actually there's a solution that you might need, or you might need to go and speak to a debt advisor. Therefore, here's a range of options, and here's a sort of signposting process for you to go and seek that additional support. But you kind of need to go through that process to know what your options are. And these types of solutions allow the consumer to get to that kind of point. And we see a lot of support through that in terms of consumers going through for debt advice, but also putting payments plans together for the creditors as well.
Okay, thank you. Well, I've got a couple of quick sort of little questions from people I've been talking to. And then I'm going to sort of go to final comments from everyone. Just in terms of people's own attitudes towards debt, are we confident that people are taking the sufficient responsibility for their own debt, for their own finances? And this is sort of from Claire at Share Group. But I'm sort of slightly reinterpreting it. But are we confident that we're all sophisticated enough, mature enough to manage our own finances? Who wants to have a go at that first? Let's take that to Joe first, please.
Yeah, so it's an interesting question. Are we responsible enough? I don't believe we possibly are, and I think the reason for that is we've been in a very unique situation last couple of years where the levels of forbearance have been beyond anything we've ever seen before, and actually the responsibility was almost put back into the hands of the creditor, because you could, without very little justification or evidence, you could be given a significant amount of forbearance on any of your payments that were due. So I think there's going to be a bit of readjustment, like we are seeing in every other walk of life, where that responsibility needs to go back firmly into the hands of those responsible for the debts that have been incurred. Whereas I think up to now, and probably a little bit into the future, the responsibility has kind of been passed back to the creditor.
Okay, thank you. Lukasz.
Thanks. Yeah, I think I would disagree slightly with what Joseph was saying. I mean, well, there are certainly elements that can be improved about, education and helping customers understand better what types of products they are getting, especially the ones with many loopholes or some, hidden things that they can get hit with unexpected fees for like even 1 day late payment. But in general terms, I think, when we consider the macroeconomic context, I could come back to what Jonathan was saying about, people just don't have enough income for essentials. And then, if they have no other choice, they are being pushed into debt that they may not have wanted to otherwise take. So I think, there is the responsibility on the side also of the government on how this income floor is set. So for example, the government did recognize at the beginning of COVID pandemic that the social security payments were too low. We had this £20 uplift universal credit, but then the government, last autumn decided against, massive campaign by pretty much entire civil society, I would think, to withdraw it. And now we are having massive inflation, but the benefits are not being updated with inflation until at the very least next spring. So people will have, very hard winter that they already lost this to £20 a week. They are not getting, that their benefits are paid to inflation. So what choice do they have? So I think that this is like a very important systemic issue.
That's great. Joe, maybe you can reply quickly to that, like 20 seconds.
Yeah, no, I don't disagree. I think we're quite unique. The fact that we see everything at the back end of the solution. So when you're entering into legal litigation, that's last chance saloon for a lot of people. So I think the experience of others is probably further, earlier on in that process, and there's probably more engagement at that point. Whereas I think we see probably a lot of people at that point have probably given up a lot of hope.
Thanks, Martin.
Yeah, I think just to pick up on that as well, I think back in the day, we used to think of collections being a can't pay, won't pay type of position. And I think perhaps, Joe, you're sort of more in the won't pay by the time they sort of get down to that position. I think what we see, and go to Lucas's point there, indebtedness now isn't just about unsecured debt. It's about utilities. It's about the changes to benefits. There's a lot of sort of much wider things that are affecting your ability to pay. And that, as we're saying, 42% of customers are engaging with a digital system to be able to, help them. So there is a desire, I think, generally from consumers to try and, sort of manage and provide information to creditors.
Jonathan, briefly, please.
Yeah, I think it's quite a small minority that won't pay. I don't think anybody likes to be in debt and doesn't want to take responsibility for that situation. I think when you approach somebody for debt advice, you are taking on responsibility for that situation, whether you are the cause of it or not. And we as an organisation, it's a very intensive service, so that when people are with us, it's a lot of hard work to get yourself debt free, whether it be through repayment or through insolvency. And they are taking control of that situation as best they can, despite these wild circumstances that are beyond their control. So I think it's a very broad kind of question. I think culturally we have a problem in that we're not very good at talking about money. Lloyd's did a campaign called the M word to get people talking, with friends and family about money, about being open, about not locking it up, because so many of our clients approach us for help at a breaking point when things have gotten really bad because they've tried to deal with it themselves. They feel guilty. They feel like they've let their family down. They feel like they've let themselves down. They don't know if there's any help available necessarily. There's so many emotions caught up with it that it's not a case of like, stuff it, I don't want to pay that. It's an education piece, but it's also like the emotions that are wrapped up in debt as well. But yeah.
Thank you. A question from Paul Neal at Sascoms. Just 20 seconds each on this one, please. Do we expect the size of the credit industry to increase, i.e. with more agents on the streets and so forth, or are we going to become increasingly reliant on technology? Martin, do you want to have first go at that?
I would probably say the technology more than the agents on the streets. I mean, volume's increasing. And there needs to be a way to manage volume. I think looking at the way the regulators and the financial services regulators are addressing this marketplace, it's very much more around holistic solutions for consumers. And I think we will start to see more tools and more uses of tools rather than collections activity. I think there's more we can do there, and I think the regulators would support that.
Lucas, please.
Yeah, I would agree with Martin. I think like technology is the direction of travel we see across finance. So I would expect much more happening on this side than on having more agents in the streets.
Joe.
Yeah, I totally agree. I think more technology. There's no new players coming to the market, and I think the reason for that, the bar to entry now for regulation is significant in this space. So what you've had is a consolidation of smaller businesses and firms. No new players coming to the market, and I can't see that being fixed anytime soon.
Jonathan.
I think we always need some boots on the ground. There's always going to be those people that need that help face to face in a different way. But obviously, you've got to whole new generations of people where, say, buy now, pay later, maybe their first foray into debt at a very young age, and so, but they're going to be so much more tech literate that they're going to access advice and help that way. But we've always got to have some sort of safety net for those that are isolated.
Okay, that's great. So my final sort of question really, and sort of I'm going to include this for the sort of any final comments points. So I'm going to put you all in 10 Downing Street for 60 seconds. And so look, you've got three things now, three wish lists, three policies that you could implement to help the country get through any debt crisis as smoothly as possible. What would those three policies be? And we're going to go to the Economist first, because I think he's already got one or two ready in the oven. Lukasz, please.
Thanks, Gerard. Yeah, absolutely. At the Economics Foundation, we have a few ideas. So I would start with, when I was speaking of the income floor, so we are campaigning for what we call a living income. So more generous, like social security net, safety net that catches everyone and provides a higher level of support than current universal credit. So people don't plan that hard or that low when they lose their income. They need to have income sufficient by necessities that helps them, even move between the jobs or protect them from, any things happening to them. So that would be one idea. And second, maybe wrapping up quickly, thinking about inflation, increasing prices, a lot of that is driven by energy and a lot of people spending going into energy. So we have this campaign we call a Great Homes Upgrade that is about a big governmental program of energy efficiency across UK homes to help people massively reduce their gas bills and eventually electrify and have clean energy, which over the longer term would reduce expenditure on high fossil fuel prices and help people preserve a part of their income.
Anything else?
Oh, yes. If I have a third go, yes. So we also are doing some work on what we call universal basic services. So stepping outside from the pure monetary support as with universal credit or grants for retrofits, we think that the provision of services should be increased, that the state provides for free. So currently NHS is the core example that is free at the point of service. But I think there's more scope for that, in particular around childcare and social care, which are the two very big items for people who need them and take large chunks of income, either for parents or for elderly. Yeah, we're working on proposals on how the government can fund and hugely expand this provision of services. And then when people don't need to pay market prices for those things because they are funded by the government through taxation, ideally progressive taxation, so those most able to pay fund a big share of that. That I think would again be a big policy to help reduce people's struggles with their money.
You got a landslide. Right, Jonathan, please.
I'll try and say something that hasn't been said already. I would ask them to revisit the rates at which deductions come off universal credit, because huge percentages of £300 a month leaves you with very little in this cost of living crisis and before. I would say look at a greater provision of alternatives to credit for people who find themselves in financial difficulty. Stuff like the no interest loan scheme, which is a really positive step in the right direction, but there has to be alternatives to credit in a pinch. And I would say I was going to say just make sure there's the correct or appropriate provision of funding for debt advice. It's always a hot topic, and but it's just making sure that the agencies that need funding, that for face-to-face and things like that, get the support that they need.
Thank you. Joseph, please.
Yeah, maybe not so much government policy, but I'd be looking for industry standards to be set, probably in the vulnerability space, but also in the affordability space. I think if we can get consistency by all creditors across the industry on those two terms, that would make everybody's lives a little bit easier.
Anything else?
No, I'd be happy with those two.
Good. Easy win. Right, final. Martin, please. Last word.
It's difficult to find something that's not been said.
Okay.
Yeah, so I suppose one that hasn't been said, I'd remove I'd get rid of 0-hour contracts. I think that's quite a damaging thing at the moment. I think more focus on things like credit unions. I think definitely, again, there needs to be more avenues for people that need to save and need to borrow. I think credit unions is a good way to be doing that. And I think just the energy saving schemes, anything energy saving, electricity, I think more direction against for those kind of schemes.
Okay, great. Thank you so much. I can't see any unanswered questions in the chat. Anna, was there anything finally on the technical point that we need to think about, or are we good?
No, well, we are good now.
Okay,
Like
well, fine, yeah.
Almost had a heart attack.
Ah, don't worry. You can cope with it. You're still brilliant. Okay, so I think the recording will go out in the next few days. We'll try and produce a little summary report. And thank you to all the attendees. Has anybody got any final comment, or are we good to go? No. Well, thank you very much indeed. Thank you to Joe, to Jonathan, to Martin, to Lucas, to Anna and James on the tech side, to Russell for chipping in as well, and see you next time.
Thank you.
Thanks,
Thank you.
Bye-bye.
Thank you, guys. Take care.